What's up, guys? Welcome back to DCA. So what we're going to do in this video is just run over a few metrics and kind of show why what's going on right now is happening. So if you follow this channel, you'll know that ever since December, we've been talking about the fact that you need to watch out in this market we're in right now. So ever since we crossed below that 20-week moving average, we've been making videos talking about getting below that is typically a bad sign for the market. We said you're typically going to go down to the 50-week moving average from that point. And that's what we did. We went down to the 50. Then we crossed below the 50 and we said, watch out. When you go below the 50, it's usually a bad sign and you're typically headed for a bad place. So at the end of the day, everything that we've kind of been talking about for quite a while now, it's all sort of playing out in slow motion. Now, this bleed that we're on is just, we haven't dumped, and I don't know that we necessarily will. But given all of the macro conditions that we've been talking about for months and months now, supply chain issues, inflation, I'm not going to reiterate everything right now, but we've been talking about all of these things for months. And you're seeing it play out in the price action. You're seeing the weakness in the crypto market right now. And it's not anything negative against the crypto market. The crypto market is in an incredibly strong place fundamentally itself. And that's a key point here. Crypto is in a fundamentally strong place. So keep note of that, because the market, the general market, the economy, not necessarily even the economy. The economy is actually doing fairly well, all things considered. But other macro considerations are extremely weak right now, okay? So you have sort of a dichotomy at the moment. You have two things going on. You have, at least with regards to the crypto market, you have a strong crypto market, fundamentally speaking, but then on the side, you have all of these economic issues that we simply put have to face. These things can't just be put off forever. And I know a lot of people out there in the social media space, YouTube and Twitter, they don't understand that. They simply don't understand macroeconomic factors. And so they're ignoring them and they don't understand their importance. So they keep telling you that, we're going to the moon right now, institutions are FOMOing in, but they don't understand the dynamics that are at play at the moment. So when you have a fundamentally strong asset, take Google, for instance. If we were in and let's talk, post IPO Google here. And when the market corrected back in 2017, 2018, when we had that small correction, that's the best time to be picking up assets that are, fundamentally strong. And that's what the cryptocurrency market is right now. It's a fundamentally strong asset that obviously has a lot going on, but these things are all happening kind of in the background right now. And they're not going to necessarily be reflected in the price, particularly if the market continues to crash. So that's why I always suggest dollar cost averaging. It's why I repeat it every single video I make. Because if you're someone who's FOMOing in, FOMOing out, moving all of your money around every single time you're going in or out of any position, you're ultimately going to get shaken out by the volatility in this market. And you're seeing that right now. You're seeing it play out over and over again, where we'll swing wildly up to, nearly $50,000. And then, oh my God, the next week we're down at $38,000. And so people keep getting wrecked by this. And there's so much misinformation out there. And quite frankly, a lot of the, the resources that people have available to them in this space are via social media. And so you have people with absolutely zero qualification to be giving advice doing that. And I think it just leads to people sort of never knowing which way the winds are blowing and falling victim to, FOMOing in and then FOMOing out. So they don't want to get wrecked and then they don't want to miss out on the pump. So you're seeing this just play out repeatedly right now. So we're in this little macro uptrend, right? And at the end of the day, that's fine. But if the stock market, and I keep trying to reiterate this, if the stock market dumps, This little macro trend, do you think this little macro trend that we're in right here, this little line that you can draw on a chart right here, this macro trend is all well and good. If the stock market dumps, that little line right there is not going to save you. Okay? I assure you that. I'll put my money where my mouth is. If the stock market crashes and we continue on that upward trend right there, that little line, if that line saves you, I'll quit my channel. So at the end of the day, you know, you need to consider what's going on. Now, I'm not saying we're definitively going to go down from here. That doesn't have to happen, but we are going to be at the mercy of the broader market. And that's what people need to consider. We aren't just, you know, acting in isolation out here. So the first thing we're going to look at is the DXY. And this should perhaps be the most concerning thing to you. It's the most concerning thing to me anyway. So the DXY, when it's going up, individuals will tend, or, you know, individuals are tending to move towards a more risk-off atmosphere, or the market is moving towards a more risk-off atmosphere. And the DXY is right now, as we speak, breaking through a multi-year level of resistance. Okay. So we are sitting right here at this 101 level. And if you go back, this level right where we're at has acted as a level of resistance now, dating pretty much all the way back to 2017. So we've been rejected off this level and we're going above it right now. You know, this likely isn't going to be a great thing for the, you know, for the crypto market. Notice the last times the DXY has made a big turnaround. Okay. And see if you can think of anything that's happened in these years for the crypto market. 2014, there's one. 2018 into 2019, there's two. Starting in May of 2021 up until now. So every bear market that we've had has come during a DXY rally. Okay. So 2017 basically was a huge bull market for crypto, and that coincided with the DXY falling. Okay. In fact, it fell from about where we're at right now all the way down to where we were before it turned around. And then we started into this more bearish segment of the market. So that's the first thing to note. The second thing we can quickly look at is, let's take a look at the volume. Okay. So the price volume of Bitcoin. So this is a measure of how many dollars are being traded on the asset per day. And I'm pointing this out for you because of the fact that you can see that when the price volume is falling, these tend to be bearish times in the market, when the market is losing value. So notice that from 2018 all the way out here until the beginning of 2019, we saw the volume being traded on the asset, or you could think of it as liquidity being traded on the asset, is dropping. All right. It's dropping, and essentially we don't start moving up in price again until this price volume starts increasing. Now, you'll note that right now that is happening again. On the chart I'm showing you, it may not look severe. Okay. It doesn't look like that big of a difference, but let's do this. Instead of looking at it on a log scale, let's look at it on a regular scale. So when you put it onto a regular scale, you can see that it's drastically different. Okay, so we have fallen, the price volume, the amount of volume being traded on the asset from its peak has dropped by about 85%. Okay, so it's not an insignificant amount. Now, you might say, well, that's the peak, you know, that's sort of a, not quite a, maybe a blow off top, but it's, you know, during the middle of a bull market. So a lot of retail interest. And that's right. And that's the whole point here. When the retail market is not participating in the crypto market, this is what you see. The price falls. There's a direct correlation between the number of dollars coming into the asset, because it's a newer asset class, right? So dollars that are being traded on the asset are typically going to be new dollars being injected into the market. And we're not seeing that right now. We're seeing the opposite. We're seeing less capital coming into the market. As interest rates are raising, credit becomes less available, it becomes more expensive, and therefore There's less money being injected into markets. On top of that, the Fed is going to begin pulling money out of the markets that they have put into it since 2020. So we're going to see the Fed taking assets off of their balance sheet, pulling that money out of the markets. And I think this is just, this is going to continue. It's not going to get better as the Fed is pulling money out of the markets. The one perhaps positive that we can look at. So what we have here is just the price. And what we have here are the number of active addresses. All right. So notice that in 2018, 2018 is a good sample to look at. So we saw the active addresses just plummet. Okay. And during that time, here came the price. We hit our peak in 2017, and then we came down. All right. We came down, and while the price was continuing down all the way through 2018, all the way into this capitulation event in late 2018, early 2019, we saw the active addresses fell, but then they slowly started rising again. And so these are people starting to get back into the market as they start to see, hey, I think I want to be in the crypto market now, but I don't want to pay 20K to get into it. So, they leave the market, but then they start to come back as the price falls. As the price falls, they're hoping that they're buying into the bottom, but, with the realization that maybe they're not. And in fact, here they were not. But more and more people remember what happened here, the 20K. More and more people remember here, the 60K. And then ultimately, here and here, when we went nearly up to 70K. And so what are we seeing? We've seen the number of active addresses plummet, all right? And you'll see that it's almost identical to this move we made here. So this May move, we plummeted. But now we're slowly starting to rise back up again. So the number of active addresses is increasing yet again, but it's doing it just like it did back here in 2018. And so this thing takes time. This type of thing takes time. So we have people coming back into the market, but they're not going to lead to an instant, increase in the price of Bitcoin. It's going to take time. So that's what you're seeing. There's numerous things happening right now, and you need to be aware of them. The bottom line is you need to understand these things. You need to understand that as the DXY rallies, it's at 101 right now. That's officially breaking above a resistance level, an important resistance level, in fact. Now, that doesn't mean it's going to close above that level, but, ultimately with what we see going on with the Fed raising interest rates and with the inflation levels, the last thing I'll say is this: you need to understand, why is the DXY going up? It's investors leaving perceived more risky currencies and coming back into the safe haven currency, which they see as being the US dollar. Okay, so that's why you're seeing the DXY increase. Take a look at the DXY's one of its main trading partners. This is the Japanese yen. Look at what the Japanese yen has done ever since 2020, ever since COVID. The Japanese yen has absolutely tanked. So if we measure where it's gone down to, the Japanese yen has lost 20% of its value since 2020. If we look at the euro is the same thing. Ever since October of 2020, the euro has been on a decline. Now, with that said, over the last 3-month period, it is in fact up. The euro is it's the biggest component of the DXY. So you can see that, it's sort of hit a support level like we drew out here. It hit this support level down here at around 984. It bounced off of that support level and now has actually maintained around here at 1,000. So there's a lot of things going on right now, a lot of important things. And I think you need to really pay attention to this and not listen to these people, just telling you every single day it's going to the moon. Ultimately, it could go to the moon, and that's fine if it does. But, because I don't recommend you go panic selling anyways. I recommend, I'm not giving you financial advice, but I would not go panic selling. I will not go panic selling. I'm going to continue my plan of dollar cost averaging. If we go down, I'll dollar cost average. If we go up, I'll dollar cost average up until a point, and then I'll begin to dollar cost average out of the market. So that's it for this one, guys. If you guys like this type of content, hit like and subscribe. And until next time, as usual, see you.